All right, what's up, everybody? Welcome to the official Trade Talk channel where I show you how I analyze price for the most consistent and higher probable entries to help you all become better traders. Today, we're going to be looking at the FOMC meeting. We are also going to, let me get rid of this link or the browser bar. You don't need to see that. All right, we're also going to listen to the Fed conference or the Fed press conference if it will allow me to do so. But the main thing that we're wanting to see is the rate decision itself. We're trading currently in the middle of nowhere for my liking. I would have much rather it been trading much lower down here to this monthly support level. But you're kind of trading what looks like, you could potentially see some downside. I do like the fact that the S&P 500 is trading at the lows. It doesn't have really much further to go. As far as liquidations are concerned, you've already done it for the day. So we're not going to be looking to take any positions on the S&P 500, but what we will watch is we will watch Bitcoin. We will be looking for potential entries on this asset. My current game plan is when we get the news, when we get the rate decision, I expect to see a spike. And whichever direction that spike goes, I will be looking to fade that move by taking a position. There is the previous month's high setting at $20,691. That is this month, so November. And then you have November's low right there that is untouched. It's only 2 days old naturally, so you don't have a very big monthly range, but there it is. If you go back out to the higher time frame here and look at the monthly, this is currently where you're sitting. All right, so is it possible that we get a run all the way up there? No, I don't expect that, right? I expect a big move, but I'm not really expecting a liquidation of the previous month's high or low. What I would like to see is a test of monthly support, but we're trading well up off of that, and I don't know how big of a spike you're going to get, but I don't really honestly think that you're going to come all the way down here, just because of where you're trading. So it makes sense to me to maybe just target this current month's high and low and then see what happens from there. So we will be trying to take that entry. Like I said, we will be trading with live funds. There is a link in the description it's an affiliate link for Bitget. That is the exchange that we use. If you do want to sign up to Bitget, they offer the cheapest fees in the entire crypto sphere. You make sure you use referral code XTSC. That is X-Ray Tango Sierra Charlie. All right. So yeah, that's that. That's the platform we're going to take the position on, and I will just keep this up here. We currently have a short position on the USD/JPY, but it was already initiated a couple days ago. So last week or the week before last, we're just wanting to see this thing break down and see if we can get that. A lot of talk on Fed pivots and all of that nonsense. It's not a pivot. Even if they come out and only do a 50 basis point rate hike, that is not a pivot. A pivot is when the Fed goes from being hawkish to dovish. So they go from hiking interest rates down to lowering interest rates. That is the pivot. The only thing that you could say is that they are slightly less hawkish. That is it. A rate hike is still a rate hike. It is still a hawkish Fed. Therefore, that is not a pivot. That is not what we are looking for. In fact, with the higher GDP numbers and we got a higher PCE number Friday, I would almost be willing to guarantee that the 75 basis point hike is coming. It will be the press conference after at 2:30 where we actually get to hear what Jerome Powell has in store for the future. We will have 2 CPI numbers after this rate decision for the rate decision in December. So what I'm assuming is going to play out here is we're going to get the decision, and then the Fed is going to speak, and that should carry the rest of November's expansion So since we're trading really close to the low and to the high of November, that's why we're targeting that region to look for the fade trade, if you will. So one more time, what I want to see is I want to see a spike under the November low down into here. I could potentially look to take a long trade down there, and I will be targeting, the daily high. All right, the current daily high, and if we get up there, we'll take profits, move stops to break even. If we get stopped out, we'll leave it alone. We'll have to wait until non-farm payrolls potentially to take an entry. Well, that's not true. We'll probably get an entry tomorrow morning, but we'll see. We just got to see how this plays out today, right? Nobody knows what's going to happen, but there are your current daily ranges. So just getting under the November low would also take out yesterday's low. Same for the high, because yesterday was the open of the month. So that is your range for now. So yeah, we're looking for the previous day's lower high to get smoked, and then we're looking for price to return in the opposite direction. But like I said, on the S&P 500, you have already done that. You have already liquidated the previous day's low. Right there was yesterday's low on the SPOOs. Today, you've already liquidated it, making a fresh daily low there. So there's not really much on a technical basis to go by on the SPY, on the SPOOs. You can look at last week's range, maybe potentially fib that, and that's about all you got because you're trading in the middle of nowhere up there, right? So we'll fib last week's range, and we'll see if you can get a spike drop down into that region. But once again, we're going to be mainly focusing on Bitcoin during this stream because the S&P 500 does not have a setup, but Bitcoin does. Bitcoin has currently got a beautiful setup. We just got to see how it plays out here. All right, so 75 basis point rate hike is already priced into the market. I will pull this up over here so you can see it. This is the Fed tool, so you're going to see that there was an 88.2% chance that you're going to see a 75 basis point rate hike. So more than likely that's been priced in. You might get a small spike, and then the news comes out. You could potentially see that move be faded. Any entries that you took today inside of today's range is likely going to be stopped out. All right. If you have already entered into a position, if you are long or short, it doesn't matter. If your stop is setting just above the daily high or just below the daily low, there is a very good chance you will be stopped out. Now, I don't know that you're going to liquidate both areas, right? I don't know that. I'm just saying, you're right in the middle of the monthly range right now of November, but it's only 2 days. But you can see the blue line here. That is pretty much, that's your high, that's your low. So you're pretty much right in the middle. It can literally go anywhere. So I did post something on on Twitter about the S&P 500. It's an amazing it's an amazing little piece of data. The fact that we are currently trading around the same price when we got the last Fed speech or the last rate decision. So here is the 21st right there. That's the 21st. That's the candle we got from the rate hike. So on the daily open is there. So you can see that the S&P 500 gave back all of those gains that were made to the downside, and you are trading right back to the same area where you were trading when we got last month's rate decision. I just think that is very, very strange, to say the least. So right now the market's poised to look for more upside. You do have a legit breakout, whether you use trend lines or regular horizontal support and resistances. You do have a breakout going on your hands. So we'll see if that breakout has any legs, or we'll see if the sellers knock it right back down to the lows. So I don't know if you're going to see that or not. Like I said, it's just strange to me that every bit of the losses you suffered from the last rate decision have been bought right back up. So it does appear that there is buyers in the market, and we want to pretty much stay on the side of the near-term trend, and right now that is up. But like I said, if that first initial move is to run higher, then we'll probably be looking to short that if it occurs. All right, what's up? Good morning, or good afternoon, I should say. Thank you guys for being here. Let me see what's up. Good morning, good morning, good morning from Asia. Good morning, my friend. Good afternoons. Often it's just a spike up or down, then go. How do you even catch that? Well, you're watching the monitor. You gotta have your eyes on the monitor when it happens. So you're going to be looking at the monitor at 1:59 p.m. 1:59 p.m. And then you spread the market out, or spread the chart out like this. If you're focusing on one asset, like I said, these are the two liquidation points that we're looking at. Here. There is a monthly support well under us down here, but I don't know if I'd want to buy that. I would just want to see a liquidation of it and then a bounce, right? So yesterday you had a pretty, not yesterday, but a couple days ago, you had a pretty decent move to the downside here. But you're basically trading sideways for the last 2 days because the market's waiting on this. This is what we've been waiting all week for, and it is here, baby. Yeah. So I don't put a limit order down there because I used to try that. But what would happen is the wick or the spike would be much more aggressive and bigger than I thought it was going to be, and it would run down, trigger you into the trade, and instantly stop you out at the same time. Because, the price gets volatile, the spread widens up, and it doesn't take as much to stop you out. So what I do now is I just wait for the spike to happen and then market into it if I think it's going to roll over. Right? If it's going to go in the opposite direction. So what we'd want to see is we'd want to see a wick, flash wick entry straight down to here and stop just under the low. Or the same for the sell side if we're looking for sells. You want to see a wick straight up to there, and that's it. Just a little bit above that. And stop. If you get another impulse, then it's not a sell, and it did not provide a buying opportunity. But remember, we could see whatever happens today, even if it's really bullish or really bearish all day after we get the news event, after we get the press conference, that move could be faded. We have non-farm payrolls on Friday. And it's not very often that you get an FOMC meeting and then non-farm payrolls 2 days later. Not very often at all. But the way the Fed has this situated is they're going to have that jobs number, and they're going to have next month's jobs numbers, and they're going to have this CPI and next month's CPI. So they're going to have 2 jobs numbers and 2 CPI prints in December when they have this FOMC meeting again to make, further decisions on what is the outlook for the beginning Q1 2022, right? So we'll be watching that one too. We'll be ready to go. For now, we got 10 minutes. But yeah, you use a market order. Do you expect more volume at 2:30 then? I do. I think you're going to get the initial liquidity run on the first spike. Then, you might see price trade a little bit lower or a little bit higher. And then when he starts speaking, depending on what he says, that is the direction the market will go. You can go back in time and look at what happened on the 21st, on the last month's rate decision. Right. No, that was not it. That was CPI. We want September 21st here. All right, so right here you go. This is last time right there is your 1 o'clock candle. So coming into the rate decision, before the rate decision happened, you had a big bullish spike. 2 o'clock, boom, you took out the high of day. You see this wick ran all the way down here, stopped out the low of day, then bounced all the way back up. 2:30 rolls around, and then this thing rolls over. So you could get something like that, or you could get a small move or a muted move if they just keep everything the same. Because like I said, if it is just going to be a basis of 75 basis point rate hike, and then they're not going to give us anything yet because they want to wait on the next two job numbers and they want to wait on the next two CPIs, and he's not going to say anything. He's going to be cryptic, and the market could just potentially be a chop fest. But we've been trading sideways for multiple days, so I do expect we'll get some expansion. Even if it is a down move, we could still potentially watch monthly support to be buyers. As long as you're not trading under monthly support, I think you can be a buyer. If you're under it, then I think we need to be looking to sell swing highs. If you want to be a seller now, then you should have been selling the swing highs coming into today's event. Right? So we kind of got the same thing again today, right? A nice, strong, bullish candle coming into the news or just before the news. We got 8 minutes until the news comes out. Trader John Heath is looking for yesterday's. Oh, yeah. Okay. No, thank you, Aaron. 100x leverage. I don't suggest you do that. You will pay a lot of money in fees. I promise you, a lot of money in fees. I mean, it'll take probably a third of your account just in fees. And then you're going to need an 80% move just to exit the position with a win. Now, I have my leverage slider set to 25x, but like I said, I am a professional. I do this every single day, day in and day out. I'm already up very well on the week. We had 2 nice trades we took on Monday and Tuesday, so we're in great shape as far as profits are concerned, and we're not going to risk much more than about 2.5 to 3%. I do risk more on Bitcoin than I typically do in FX. In FX, I only risk 1%. That is 1%. Always. Euro USD, like, it's already made a fresh daily low as well. I don't necessarily like that, as far as the buying decision. But we'll see what happens. All right, we'll see what happens. Let's get Bitcoin back over here on the big screen. All right, we got a few more minutes to wait. Let's go ahead and pull up the news here, the economic calendar, so that way you can see right here is what we're waiting on. This will be the interest rate decision. We're trying to go from 3.25% up to 4%. If it does come in line with 4%, you want to see a number 4 over here. That means that we got the 75 basis point hike. Anything under that will mean that you didn't. That you got, a little bit less. And that could be bullish for the market, and it could be bearish for the market. There's no way to tell how the market will interpret that info. We just have to wait for the market to interpret the info and then post up, show us what direction it wants to go. And then we can look days to come for, support if it wants to go higher. And if it wants to go lower, we'll look to sell resistance. So even if we don't get a trade today, we will ultimately find us an entry. So yeah, that's what we're going to do. Dow is 12% away from the all-time high. Yeah, I know Dow has had a phenomenal rally. What time is it? It's 1:54. All right, I got 6 minutes, so I don't want to get too much on a rant. But yeah, you're 100% correct. The Dow has had a phenomenal rally. There you go. There's the Dow on the hourly. If we pull this up here, you're going to see this looks a lot more like here is your rate decision on the Dow. The last rate decision we had on the Dow. You can see here that forced the markets lower. This is when you made a fresh bear market low. You came down, you liquidated the low, and boom, shakalaka. Magnificent rally off those lows. If you go from swing low to where price is currently trading right now, you're going to see that you're up 14%. So in '08, the S&P 500 had a 14% rally off the lows before then finding resistance, rolling over, and going down and making fresh bear market lows. So is that what we have playing out? Are we just witnessing a bear market rally? If we are, then we're going to be wanting to look for resistance. On the S&P 500, you can see 12.8% to the upside. And that's after making a fresh bear market low. That is the exact fractal that played out in '08. The exact same thing. So it is possible that we do see new bear market lows. And this is a possible selling event. I just think that if you were looking for shorts last week, you were early. You were early last week. This week is a different story. How far can you likely go? I wouldn't doubt it, a liquidation above the high. So that's where you're going to be looking for sell side entries on the S&P 500 is going to be resistance right there at 39.11. You would want to see a spike up into that, wait for the liquidation, wait for the swing high, and boom, take your short trade, throw your stop above the wick if you think it's going to be a continuation of bearish markets. That's the thing. A lot of people are positioning themselves for that. But last week on the SPY, 2 weeks ago on the SPY, we saw two big, massive bids come in. So people are also taking positions to the upside in anticipation of a lower inflation number. Lower inflation kind of means that it's working what the Fed is doing. If the inflation number keeps trending higher, the Fed will they will hike more rates and the market will be more bearish. Essentially, that's the understanding, or that's what everybody wants to happen. What actually happens are two different things. So we're going to be prepared. We're going to be watching this. Another thing that you can do is you can flip this auto switch on here, so that way if it does drop well below, it'll follow it. I would just suggest to look at the hourly, because the price isn't going to run off the screen. Not from here, right? You'll see a flash wick up or down. Let me go ahead and get over here, get everything ready. All right. And in this extreme volatility, I would also suggest that you use a smaller position size. Because once again, if this meeting is going to call the directional bias for the rest of the month, you will be positioning yourself pretty damn good to catch that ride. So you don't need to risk a whole bunch of money in anticipation of trying to make a whole lot of money. You just will if you catch the trend. If we catch the trend. All right, we got 1 minute. I'm going to pull the rate decision up over here on the other monitor. And you guys will probably know before me what that decision is. So here we go. Get ready. I should at least play music while we're waiting for this long ass minute to go by. Come on. There we go. We got it. I do not see anything happening. There goes the liquidation to the downside right there. So this scenario, you would just mark it by that. All right. There was a market buy right there. Right, my entry on the Bitget platform is 20173 to the bullish side. Stop is going to be 20216. Very volatile. We could get stopped out here. Actually, I'm up 19%, so I'm going to go ahead and knock half that position down. I'm going to set my limit take profit at 20504. If I can, it's already went there. Shit. All right, so I got to move it up a bit. 2054. Oh shit, now we're at 561. There we go. Fresh daily high. So you made a fresh daily low. That was my entry right there. I'm trying to take profits, but it keeps moving up so very fast. 20629. Let's see if that works. And I want 70% off. All right, boom, I got filled. I'm out. I still have 1/3 of the position size on. I just booked. I can't see the percentage that I booked, but it was, let me do the math real quick. About 25% gain there. Now we'll just leave the stop setting at your entry or above it. So that way, if price does come back down for the press conference, you will be stopped out. You will already be profitable. All right. And that is the liquidation break strategy, guys. It's as simple as that, right? High risk news event. You go in at higher time frames, find your liquidation points. Like I said, it was the beginning of the month. So all I was looking for, the previous day's low to be taken out or the previous day's high to be taken out. As you can see, you have a fresh monthly low and a fresh monthly high currently right now. So as of right now, this is your new monthly low. That's your new monthly high. My bid or my bullish entry is right there. I mean, I almost got the bottom tick. Right there. That's where my entry is. You can also see if I prop a line up over here, how it came right into that support. This is the same entry on Friday, the same bullish price on Friday that I took for the PCE price or for the PCE news event. I got long right there. So now you have a fresh monthly high and a fresh monthly low. All right, so I want to get my stop loss to better than break even, and we'll leave this position on and see whatever happens. That's it. That's done. We're done. We're done for the day. Quick 25% profits. Have, quite a bit of money still on unrealized P&L. I don't know exactly how much money that is because I'm trading on the inverse swap contract. Just give me a second here. Not too much. Yeah, it was a fantastic trade. Fantastic trading. We're 3 for 3 this week on nailing Bitcoin trades. I need to get that stop loss in before I get sidetracked. What's my entry? 20239. So we just want to put it right there. 20239 on the stop. Confirm. And the stop is at break even. So now I no longer have any risk in the market, save the unrealized P&L. That's what I am currently willing to risk moving forward. All right. That money, if I lose it, it's okay because I've already booked a 25% gain in the overall P&L. So no matter what, this trade is done. It's over and it was successful. Even if it comes right back down and stops us out, still made money. It is still golden. I don't have much money in this account because I just dropped about 15 grand out of it. But I will show you the entry over here. Right there it is. So you can see there, my leverage is 25x. I just simply waited for the liquidation. You see this wick here? That's what I was targeting right there. So as soon as I seen price drop under it, I just hit market buy with 100% of the position. I don't know how much money that is. Maybe about 2 grand or maybe 1,800, something like that. I'm not quite sure. But on the move up in here, I put out that take profit of 70% of the position size. I was triggered out of it. Here is my realized P&L right there. That's what I realized. Not a whole lot, right? It's not a massive win, but it's a small account. I got to build it back up. Once I get it built back up to about 10 or 15 G's, I'll knock 10 or 15 G's out of it and I'll start all over again. And that's simply all I've been doing. Because like I said, there is that little pop-up window and that is concerning. So I'm not going to leave a shitload of money over here for them to just not allow me to log in one day. That would not be fun now, would it? No, it wouldn't. So yeah. All right. Let me go back over here and I'll get on that link for the actual news. Excuse me. Trap on the hourly. Bounce volatile. Nice work. Heath, thank you for being here, Michael. Very impressive. Yeah, that's how we roll, my friend. We make it look easy over here. We make it look easy. Stop loss after market order ASAP. Yeah, you always want to go in with the stop loss if possible. So typically what I'll do is I'll just throw in the order and then throw the stop loss in right after. Right after. If you get lucky and you market order in like we did here, and like 1 minute later it goes all the way up to the top end of the range, you know, you could be a little bit less aggressive on getting that stop loss out. But I do suggest you go in there as quick as possible, because sometimes I have gotten caught without a stop loss in. I get in with a market order and then I go to put the stop loss in, and then you get another big, you know what I mean? And those hurt. Those really, really hurt bad. Yeah. It's best to do it with a limit order, but I have found when trading high event risk, you don't use this strategy on normal trading days. Normal trading days, we're looking to buy support for bullish continuation, or we're looking to sell resistance for normal sell side continuation. In those circumstances, you put your limit order out there to enter the position with the stop loss and take profit already attached to one order. So that way, when you get filled, you instantly already have a stop loss and take profit order out. The problem that I run into doing that with high event risk is, like I said, sometimes the limit will get filled. So it'll bring me into the position and then immediately, instantly stop me out. So I didn't even have a chance to do anything. It was just a simple boom, you lost money, right? And that's it. You opened the market and you lost it. So now I like to try to give it just a split second to do whatever liquidations it's trying to do. Like on Bitget, this was the main wick there that I was, looking at. On Bitget, it's almost exactly the same. You just have a little push slightly under that. That means that was the target low. And that's the lowest low since Friday. So you just essentially stopped out all the weekend price action traders, right? This wick down was just to liquidate anybody that took positions Saturday, Sunday, Monday, Tuesday to the upside, bullish positions. And this will also take out any trailing stops, because a lot of people trail their stops up too early. These liquidations are to trigger all that liquidity. You get a lot of liquidity built up under that swing low via buying liquidity, or sell stops. So this run lower is just triggering the sell side liquidity. and then running back the opposite direction. So breakout traders get stopped out. This does its job, right? It does its job. Its job is to grab as much liquidity and run, and that's what it does. So instead of being the guy that was constantly getting stopped out by these things, I decided to build a strategy around it. You hear other people say, we want to trade like the banks, trade like the market makers, trade with the banks. Well, over here, we actually do it. We don't brag about it. We just do it, right? Just do it. Fantastic stuff. Fantastic stuff. Now the speech comes out. Like I said, this could likely get sold off. So if you were looking for sell side entries, this is where you would have been looking for that to take, right? You've been waiting on the liquidation above the high, and boom. I would have probably wanted to see it smoke this high as well if it was, looking for downside continuation, but you can't be picky. We never know what's going to happen. We can find these areas and be ready for it, but we just don't know what's going to happen. But that little quick scout right there, I'm just booking gains, man. Everybody else is losing money. We're making money. And if you can do this consistently, 2 to 3 times a week, you're going to change your life. Once again, please do not deploy this strategy on normal trading conditions. What you want to do is you want to get on the right side of the trend and look to buy off support. If the trend is up, you wait on support tests, you buy the support tests. It's like a retest, if you will. Because this strategy will get you hurt. If you're constantly trying to buy daily highs and sell daily highs and buy daily lows, you're going to get ran over, because in an uptrend, you're going to make daily high after daily high after daily high. And you're going to just eat stop after stop after stop. So I only suggest this on high event risk. Let's go look at the news. Let's see here. We got 4%. So what they said was they were going to do, they did, right? 75 basis point rate hike. The forecast was 4%. The actual is 4%. So right in line with what they were talking about. So now we need the speech. I got it right here.
50.
I'm just not going to play it until 2:30 because he doesn't speak until 2:30. But our trade is done. Our trade is done. We're like the people that go in for the terrorists, right? We're in, we're out. In, out. We're the A team. Let me just do this real quick. Not a bad gain at all. And the account was setting at about 1,700 before I took the initial position. Now the account's setting at 2488. Not bad. Once again, I will lose that unrealized P&L if it comes down, but I'd rather lose unrealized P&L than lose my money. So nice little trade there, about a little less than $1,000 on that one. I took a long at 20040. I don't want to see a retest. 20040. So you got down here. I got you. I understand. You know what I mean? Yeah, you definitely don't. Just that wick right there probably had your butthole puckered. Happy FOMC trade talkers, said Wes. Thank you, Wes. I just took profits on pound dollar long entry. 1.14522. Stop loss was 1.14451. Nice work, Wes. Let's go look at pound dollar. Nice job, Wes. Didn't get a liquidation on this, but you did get a flawless test of supply right there. So nice little entry there. I don't know how high this was when the news happened. Oh, you were right above it. So there you go. Boom. Right into that supply. Up. The supply on the hourly, not the supply on the 5-minute. The supply on the hourly. There's the 2-hour supply. Hourly supply. Beautiful test of it. And up. So that's good news. It's what we wanted to see. Let's get the dollar up. Fantastic. We wanted to see the dollar roll over. So it looks like the dollar was bullish all day today. Look where it traded up to. The monthly open. And then it rolled right over. The monthly open. Right there, guys. I mean, it's a phenomenal strategy. It's so easy. Just boom, boom. And you liquidated the low. So we don't want to hear him come out and be extremely hawkish. We want him to come out and be like, we're going to stand back a little bit and give what we've already done time to work. That would be very bullish for the markets. But since you've liquidated November's low, you can go anywhere from here. But it's right in par with what we were looking for. Here's that USD JPY trade. Remember, it's set up for us this week. It traded right up to weekly res right there. I had brought that up to everybody. That was your selling opportunity. You know, yesterday it looked like it was going to stop you out, but it didn't. Ultimately, it rolled over, and here you are getting your downside continuation. So by pulling this out to the daily, you can see my entry up there, top ticking this thing. You're now at daily support. Look at this. So a breakdown would look really, really good in terms of this being the potential top. Right? In terms of that being the potential top. Is it going to be? Nobody knows, but I am positioned for it. It's a beautiful outside engulfing, or outside, however you want to call it. It's an outside day candle. It's when you take out the previous day's low, the previous day's high. Outside, that's, usually a typical bullish signal. You also have daily support here acting as support. So another area you could have been looking for long entries outside of not taking the scalp with us. But there's daily support. Price trades in, sets it, it goes. Now what we want to see is we want to see it trading above resistance. So we want to see the breakout right here continue. A measured move would put you up about 22K just based on the daily. But we have monthly targets here. Naturally, last month's high would be the first bullish target, then this, then resistance. So 3 potential targets, 21,094, secondary target, 22,778, tertiary target, 23,311. Those are long distance targets. They're not expected at all. It's just, potential areas to look for taking profits. And if this does end up being a nice big bullish breakout and a nice big bullish move, that entry that I just took today, that unrealized P&L will add up to more and more profits. And once it gets significant, or about the same amount of money as I made on the first entry, I'll cut the position in half. So I'll pay myself again in half. Boom. And then just leave the rest on for whatever. For the rest of the month. If it wants to stay open. Only use Wes's money to YOLO. Yes, I agree with that. Only use Wes's money. All right. Let me scroll down because I'm way behind on the comments. Called it to perfection. Yeah, it worked out pretty good today. I'll be on the couch for the rest of the day. Yeah, I will too. Once this press conference is over, we end this stream, I'm going to plop down on the couch and watch something on the stream something. I don't know what, but we'll find something to watch. You are welcome, Bradley. Great tips this week. My problem, or it's everybody's welcome. You know what I mean? I have no trouble with doing this stuff for y'all. You aiming at SPX short, we heading up from there? No, I haven't been on a short. I haven't had a short bias for a while. I honestly believe, that. I mean, we've seen so much downside that it's only natural to get some kind of a relief rally. You didn't liquidate the daily low on this either. So, support check is what you would have been looking for the bullish entry. Intraday support, naturally. And you can see how that wick just fell right into that. That would have been your opportunity. It's not hindsight. This is how we operate on a daily basis. Is it possible that you could short this? Yeah, it is, right? This whole entire move could be faded at the speech. Is it on par with the near-term trend? No, it's not. By looking for short trades, you're actually on the wrong side of the trade. Maybe. I don't know. You know what I'm saying? That was a massive liquidation there. If I was looking for shorts, I would have only wanted to see it liquidate the daily high, which would have been there, and then get just a little bit above it and roll over. But we've done the exact opposite of that. It looks to me like this was right in line with what we were talking about Sunday. Perfectly, right into what we were talking about. It didn't get as low as I thought it would, but it don't matter. We made money. 25%. 25%. Let's go look at Ethereum. It's up 2%. Bitcoin still isn't even up a whole percent. It's not a big move, to say the least. It's a big move in comparison to what we've seen happen, the last few days. But it still is just a 2% move. So Ethereum had a bigger move than Bitcoin did. And Ethereum's liquidation was very simple. Right there would have been your entry. You can see how just a very small piece of that wick sticks out under that line there. Because that's all it needs to do. That's it. That's all it needs to do. Looks good. ETH BTC. Yeah. Ethereum is stronger than Bitcoin. But we probably should have been watching Ethereum instead, but I'm not going to be that picky. My goal is to make money as often as possible, so we did that today. We didn't take any positions this morning either, because I pretty much figured that any position that you took today before this was going to get stopped out. I mean, here's your daily range. Right there is your daily open. So there's your daily high. There's your daily low. If your stop was there or there, naturally that trade is done. It is gone. That's why I was telling everybody to wait. Let's just wait. Give it time to work out. Just wait. Be patient. Be very, very patient. Sideways all day. It was sideways all day. We got 7 minutes. Run Mountain says, boom, I got it. Thanks, Heath. You are welcome, my friend. If anybody took that money, you're welcome. You don't have to thank me. It's just what we do. It is my pleasure. Yeah, I read that. It looks like a lot of people did, though. Good. Kudos to all of you who made money today. Oh, that's what happened to me looking for another entry when the conference starts. Yeah, you can if you want. I'm not going to. I don't like risking money. I hate losing money. I hate it with a passion. I have already made 25% on the day. Like, that's not bad profits. That's a good day. So I'm done. I'm done for the day. I will wait till tomorrow to look for new entries. DGIA, LOL smoke, damn bears. Yeah, it did. What's the difference between your Discord levels? Yelling at me. Braveheart. The hedge fund tier will get you into the Discord. The lower price. The hedge fund. That's all you need for access to the Discord. It's the middle tier. There's only 3 tiers there. It's the middle one. Fed meeting says, oh, the chat just mixed up. Terror Rooster, how do you manage to get filled so quick when the market is so volatile? Bitget is really good at filling you. I haven't had any problems with Bitget. There's one asset that I traded where the liquidity was very thin, and I went in with like, I don't know, it wasn't a massive position size or anything, but it ended up filling me at like 27 different prices up and down the freaking order pane. You know what I mean? So that's the only time that I ever had a bad experience. And when it all was said and done, I was a good, I don't know how far off where my original entry was intended to be. But as long as you're trading assets with a lot of liquidity, aka Bitcoin, you know what I mean, or on the Tether side of the platform, you'll find a couple of those assets that don't have much liquidity. But I'm mainly trading the Bitcoin inverse swap contract, and there's a shitload of liquidity in that because people use it to hedge their downside risk, right? Like if you're holding spot long Bitcoin, what are you doing while the market's going down? Just riding in that negativity? Okay, well, there's a better way to make money in a bear market than just sit in a long position. You can hedge that downside off with futures. In the stock market, they do it with options. So you can look at futures account as similar to like an options account. But these are perpetual contracts. So they don't ever end. They don't ever stop. They don't have an expiration. They have a funding rate, but it's not an expiration. The funding period is like, 3 times a day? But it doesn't ever expire. The contract is perpetual. It goes and goes and goes. So yeah, that's what I do, right? When my account gets to an excessive amount, I just take the profits off exchange and put them on cold storage. And I just keep doing that. It still sucks in a bear market because, usually your spot position is going to be bigger than your trading positions. So, you're not going to be able to hedge all the risk out, but you can hedge a lot of it out. Like I made money in the bear market. I made money. Even though Bitcoin's price was going down, I still made money. I didn't buy more Bitcoin. I was trading the inverse swap contract and just putting the profits in the storage. So you can make money in the bear market. You just don't have to sit in a negative position. I'm getting a nice move to the upside here. Right here, 2 minutes before the conference. DXY closed a small gap between dailies. Yeah, it was the monthly open. Was a great target for USD pairs. Yeah, it was. USD dollar on the weekly. What's your understanding? Dollars parabola days over. Well, that's how I positioned myself. I don't know that that's what's going on, right? We did know that we were coming into support down here. We knew that. So we kind of figured we would get a bounce from there, but I would love to see it be sold right back into, right? So I basically told everybody Monday or Tuesday, whenever we did the live stream for the public yesterday, that that's as far as I want to see it go, right there. If it goes up there, that might be a good spot to look for new short entries. But ultimately, if you're going to see downside continuation, I don't want to see it get above daily res. And daily res is right here. So Sunday morning, when we had the live stream for the channel members, none of this stuff was here, right? This wasn't here. And I basically said, this is the line in the sand for me for this week. I want to see the dollar reject at least from here or lower. It just so happened that it stopped that supply. Well, a little bit before. But yeah, if it is done, then I will be positioned nicely on that USD JPY trade. And I do have a couple Bitcoin positions that are opened up still to the upside from this day here, right there. When this day liquidated the previous week's high, that's when I took the short position on USD JPY. And that's when I also got long on Bitcoin. And that trade is still open. I have taken profits off of it, but it is still open. So if we get continuation, then we're going to be positioned perfectly for it. Will we have nailed the exact top on the DXY? Nope. But I will have nailed the exact top on USD JPY. Bitcoin is just cooking now. Cooking with grease. You're into daily resistance. So for you bears out there that thinks this move's going to be faded, that's roughly where you would be looking to approach for bearish entries. This is quite a bit of momentum, though. Quite a bit of bullish momentum, guys. Just keep that in mind when trying to short this thing. We discussed the trade entry before this all happened, so you had the opportunity. I mean, I talked you through it. You had the opportunity to make money. You don't want to push it. If you didn't make money this time, don't push it. Don't try to, risk more money today. Just wait until Friday. We're going to go live again Friday morning at 8:30 for the non-farm payrolls. We're going to be looking to do the same exact thing. I don't know that we'll make money, but we're definitely going to give it a hell of a shot. Money bank today. Yes, sir. What about a walk? Yeah, that would be smarter. Probably not going to the couch. I went to the doctor today. They said everything looks good. So I missed it about 2 minutes because of a work meeting. Yeah, that always sucks. Work sucks. Nice trade. Yeah, thank you. You guys are all welcome. When you leave part of the position open, do you continuously move up the stop if the market goes up? No, I do not, Andy. I just leave my stop situated where it is. If you want to trail your stop up higher, you can. There is no exact science to doing that. You know what I'm saying? It's a very difficult thing to do it well, anyways, trailing stops. But, you could do it under daily lows, like stay a couple days behind and just trail it up under daily lows. So, like, you're not going to be moving today's stop anytime soon. Now, if your unrealized P&L gets substantial, like it might be now, let me see here. If it gets substantial again, I'll leave it open. You can just take profits again and cut it in half and just leave the stop where it is. And you'll be essentially paid twice on the trade. If it's not substantial, then just leave the stop where it is and give the trade time to work out. All right, we got the meeting going. Let me get over here.
Between now and the next Fed decision, what kind of conversation?
You hush. We don't want to hear from you.
Wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs
Working
of
class.
essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
So it sounds like he's going to be hawkish.
With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Bitcoin's coming off just a little bit from that.
Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take
Bitcoin's
time,
coming
however,
off
for the
pretty
full
good
effects
now.
of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
When?
There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Now, as far as I know, there's
Our
still
decisions will
2%
depend on the
Narwhal
totality of
tacos.
incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
Here's Bitcoin. It's
We're
coming
taking
back quite a
forceful
bit
steps
here.
to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses
We
across
will
the country.
stay the course.
Everything
So
we
it doesn't
do
look
is in
like they're
service
going
to our
slow
public
down
mission.
anytime soon.
We at the Fed will do everything we can to achieve our maximum employment and
He
price
didn't
stability
give
goals.
us any info as to
Thank you, and
when
I look forward to your
he
questions.
might slow down. It's on the table, but they're not doing it now.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data
There's
that
that
bear on that
restricted
question,
chart.
guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
So they're not going to be backing off
Hi,
anytime soon.
Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So
He's not
what
going
I
to
want to do is put that question of pace in the context of our broader tightening program, if I
He
may.
ain't answering that.
And hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a
No,
restrictive level.
he's
So
gonna- yeah.
on the first question,
He's
how
really good at
fast to tighten
dodging.
policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started.
Exactly.
So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target
So
over
this
time,
might be
and we put
dovish.
that into our
Or
post-meeting
not dovish,
statement.
but less hawkish.
Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say
yeah, it's going to be based
we're going
on
to find
CPI.
it over time.
We get a high CPI.
Of course,
then he's going to
with the lags between
keep
policy and
being
economic
hawkish.
activity, there's a lot of
Lower
uncertainty.
CPI.
So we note
they're
that
gonna
in
back
determining
off
the
a
pace
little
of
bit.
future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation.
They're going to be data
So
dependent.
I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No
Okay,
decision
so
has
he
been
did
made.
answer it.
It is likely we'll have a
Maybe
discussion
December
about
we'll
this
do
at
50
the next meeting,
instead.
discussion.
Or maybe the
To be clear,
the first
let me say
meeting of
again,
2023.
the question of when to moderate the pace of increases
That's
is now
kind of bullish.
much less important than the question of how
Not
high to
really,
raise rates
but
and
kinda.
how long to keep monetary policy restricted, which really will be our principal focus.
We just
If I
have to
could
see how the
follow up
market
on that,
digests this
to what
info.
degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick?
Nick Tamaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
That's a good question.
This is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So
It's still at 8.2%.
I guess I would start
been in the
by
eights
pointing
for
to
freaking
expectations.
3-4
So if we
months.
saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're
we got
shorter.
two
And the
non-farm
truth is we
payrolls
don't have a
and
lot
two
of data
CPIs
of inflation
before we see the
this
Fed
high
again.
in
So
what is now the modern
they'll
economy.
have plenty of data
One
to
big
go
difference
by.
now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy.
Yeah.
That's the way.
That's the way you're
it
supposed
has
to
moved
trade.
for a quarter of a century
You know
in the
that.
direction of financial conditions, then
We don't
monetary
wait
policy.
for the news.
because the markets are
happen.
thinking what is the central bank going to
We
do?
expect.
And there are plenty of
Make positions
economists
on
that also
that.
think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy. And trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
They don't know what
I
they're
could
doing.
follow
I
up.
mean,
Should we interpret the
it's
addition to the
all,
statement to
it's
mean
all
that
an
more weight
experiment.
is put into those lag effects than they would have been?
They do it,
after
and then they
previous
wait on the
rebates?
numbers.
I think
and they
as
hope it works.
we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this.
Is that yellow line the open?
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections, which
now they're all
updates
down,
that. But
so
I would
yeah.
expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios.
Yeah, Bitcoin, that
as you look
hourly's
around the
about to
economy,
turn
the
red.
clearest impact of your tightening so far has been on
it's-
housing, maybe some venture-funded tech companies. It's been
There you
relatively
go.
narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And household, of
You were
course,
about to say it's an
have,
experiment too. Yeah.
strong balance sheets. And so we go into
He
this
doesn't have
with
a clue what's going to happen.
with,
He's like us.
a strong
He's
labor
trying to make
market
shit.
and excess demand
He's trying
in
to
the labor
fix it,
market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time.
Yeah.
It may
Run
take resolve.
mountains,
It may
it looks
take
like
patience.
it
It's
wants to
likely
come back.
to get inflation down.
That yellow
I
line
think
on their price
you see from our
charts is the daily
forecasts and
open,
others that it
'cause
will
now
take
you can
some
see
time
that everything
for
is red
inflation
on
to
the
come
day.
down. It'll take time, we think.
Yeah, this yellow line,
so-
that's your daily
sorry, was I
open.
getting
This
your
is a
question
line
there?
chart, but
Housing. the
yeah,
housing
you're
part
back
of
to
it.
red
Yeah,
on
so,
the day.
we
And
look at
Bitcoin
housing,
is
of course,
stretching
housing
back
is
lower as
significantly
well.
affected by these higher rates.
Like I said,
which are really back where they were
we were
before the
ex-
global financial crisis.
we were looking
They're
for
not
a profitable
historically high,
trade,
but
we
they're
got
much
it.
higher than they've been.
Right, whatever happens
and
after
you're seeing
doesn't matter
housing
to us.
activity decline.
We
You're seeing
made
housing
money.
prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market
You're
was,
at
prices
hourly
going
support
up,
right now
many bidders,
on Bitcoin.
no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit
this ain't the
was
same
very
thing.
carefully, much more carefully managed by the lenders. So it's a very different situation and doesn't
Yeah, very
present
different than what we
potential
went through in
financial,
08.
doesn't
Very
appear to
different.
present financial stability issues. But no, we do
That's why I'm
understand
not
that that's
expecting an
really where a
08
very
bear
good effect of
market.
our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high,
power,
but
Shelby.
Not by as much as we thought because the data series is volatile. We never take any one reading.
He used to be able to take positions
2 or 3
before, but
so
now they can't.
It's a mixed picture.
They made a law to where they
I don't
can't
see
do
the
it
case
anymore,
for
but they used to
real
do it.
softening just yet. But we look at, I guess as I just showed you, we look at a very broad range of data
Nancy
on the labor
Pelosi
market.
does with her
So do you
husband.
see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable
And you would think
consistent
with
2%
2 jobs
inflation.
for every unemployed person
And,
in America now,
we
those
do
wages
think that
would go up.
Given the
they're
data
not.
that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend.
Nothing's really down bad, though.
Many central bankers.
1%,
so we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing, very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing.
Wait for that.
Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed.
Yeah, he read your little
notes. Could you talk about
notes.
what this does to the public's trust in the bank, and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. And we've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that.
We were just talking about that.
The problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we
See, they used
recommitted to
be
each
able
other
game
and to
the
this
market.
institution
Now they can't.
to hold ourselves to the highest standards
Crooks.
and avoid these problems.
Why
An
can't I
update
have
on the investigations
I don't
that
need
are
it. I do
pending?
fine.
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't.
It's out of his hands.
I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted.
He's talking about.
And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points.
And
I would
inflation
not
hasn't
I would not
budged
change a word
hardly.
in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the
just
beginning
drop
of the
interest rates
pandemic
altogether.
episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on.
He's speaking
on
with
that,
a bit of confidence.
What's
I
the
mean, more
place?
so
What's the level we need to get
than
to?
he was,
to
a
rates.
couple months ago.
And I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is, once you, so I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents
held,
did.
Bitcoin
And now they're
close
coming down
green on
faster.
the hourly.
So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline. There's still some significant rate increases coming. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is we think we have a ways to go. We have some ground to cover with interest rates before we get to
worrying about
that
markets.
level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy.
Those were his words.
And doing that too soon. So I control those messages, and
talk can stop on
that's
Twitter.
my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is, and we know what our tools can do, And that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
No.
Is it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder.
It's not going to be an '08 crash.
To see the path, it's narrowed. I would say the path is narrowed over the course of the last year, really.
You can look at the data. People want to see the end of the world.
You know,
they just do for whatever reason, but it's not going to happen.
Sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
She said that was the last question. You shut your mouth.
Inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
It's still possible, but.
Fed Chair Jay Powell just wrapping up his news.
So there we go. So now all the people that are speaking, about pivoting Fed, they can now stop talking about that because it's not happening. They're going to be data dependent moving forward. Like I said earlier in the stream, we do have 2 CPI prints before the next FOMC meeting. Next FOMC meeting is going to be in December. Let me go ahead and pull that out for you guys right now. Here is the central bank calendar. You can see right there on December the 14th. So you will have 2 non-farm payrolls, the first one coming Friday, and then you will have 2 CPI prints. So they will have 2 of those big data points to look at going into the December FOMC meeting. And, if core inflation has a big drop, like from 8.2 to 8 to like 7.5 or 7.4, something like that, then you'll start to see maybe some more talks start to pick back up for him to potentially, slow the pace at which they're hiking rates. Their core and main goal is to get inflation down. They have been rate hiking. They're all the way up to 4%, and inflation hasn't done anything. Essentially, it hasn't moved. We can pull up the inflation chart right here real quick, and I can show you. Right here is your inflation rate. So the next CPI print that we get will be not this week, but the following Wednesday. I think it's Wednesday or Thursday. I do believe it's on the 10th of this month, so it will be next week. We'll get that in CPI, and like I said, we want to see this thing drop. Very significant. These little 0.1 of a percentage point drops is just, it's brutalizing everything, right? It's like it has peaked, but has it? Like it's still close enough at 8.2 to go right back up to 9.1, and that's what we definitely do not want to see. Definitely do not want to see that. So they're just going to keep their foot on the gas pedal until we start to see a significant change in this. And down here is their target. He even brought it up today. They are not raising it to 4%. They are still keeping that target at 2%. And then once again, here's unemployment. So as long as this number is low as well, anything under 4 gives them room to continue to hike rates. So what we learned from today's meeting is more than likely moving forward, they're going to continue on the same path that they're on until they get a significant change in inflation to the downside. All right. Is that overall bullish or bearish for the marketplace? That's the question. And it's not a question I can answer. Unfortunately, the marketplace will digest that information. And when we get the jobs number out Friday morning, we'll have more information. Then when we get the CPI print, we'll have more. And we'll go from there. One thing is for certain, as long as you're subscribed to this channel and you come watch us on the live streams when we do them, you're going to have a potential opportunity to make a little bit of money. Because we do trade and we are doing it for real. You can see here that Bitcoin is pushing right back down to that hourly potential support zone. It did hold when it came down the first time and you got this bounce out of it. Now it's coming right back down. So overall, the news is a little bit more bearish than bullish. I mean, to be honest with you, but we'll have to see how the market decides to do what it decides to do. The market's in search for liquidity. So a lot of people are going to get really, really bearish now for sure. So that could be all the fuel we need for the markets to go higher, for the markets to just keep trucking to the upside. But naturally, if we get down under monthly support, which I've gotten rid of it, let me put it back on the chart. If we get back under monthly support, then we're probably going to be looking to sell any resistance levels moving on from there. It's a pretty good line in the sand, if you will, for a bullish and bearish bias. You're above it, you broke down, you broke back to the upside. So as long as you're above it, I think we could still take long trades looking for support to hold. I probably won't be looking. Well, let's just see how today closes. Let's see what happens today, tomorrow, and we'll just, we'll keep doing what we do. It's not a bad day at all. You know what I mean? Not a bad day at all as far as like uber bearish news. No, we got a spike of volatility there, which is normal for the news itself. Very normal to have that spike of volatility. That's what we were expecting to see. That's how we were able to initiate our position and successfully take some profits out of the marketplace today. And we just had to wait for that. We got it. It's over. That stop position once again before we wrap it up. I have an entry at 20239 spot 50. Yeah, 202. So on this, it's way up here. But if I pull this back over, you can see the actual entry on the Bitget exchange. So that was pretty much the target right there. We wicked right down below it. That's where my entry was. My stop is setting directly there. So if price continues to push down, I will be stopped out. But I have already booked profits. I have already booked 25% gains on that position. So it really doesn't matter to me if it gets stopped out or not. You know what I'm saying? Much rather for it to continue to go higher. Naturally, anybody would that's in a bid position. You always want to see price move higher. But he didn't really say anything that was very bullish for the marketplace. Now we just got to see how the market participants position themselves moving forward. That's all we can do. All right. You guys have a fantastic day. We will be live tomorrow because tomorrow's Thursday. It will be a normal live stream, so probably around 9 o'clock in the morning. And then Friday we'll be live early because of the jobs number. That is released at 8:30 a.m. Eastern Standard Time. We'll probably go live about 8-ish, so that way we can do our analysis and decide on what positions are potentially possible for that day, if any, right? So make sure you join us then. All right, guys, we'll talk to you tomorrow morning. Make sure you all trade safe. Make sure you trade smart. And as always, happy trading, everybody.